Hey guys, Doug the retirement guy here. We got a new little thing that we're going to try. We looked at the Next Evolution Options Tradings, better known as NEOS, monthly paying dividend ETFs. There's 11 different funds. So we sat down, we bought all the different funds. We want to show you how we did and what we're going to, and we're going to do this over the next 2 months. So let's take a look at, first off, who is NEOS? NEOS is the Next Evolution Options Trading Strategies. That's why they call it NEOS. They bring income generation, low volatility, and tax efficiency to trading options. They do data-driven active management to do all this together. They have a nationwide, actually a worldwide, stream of data information that they use to see if what works and what doesn't work in most of the trade options that they're doing. Now, all of theirs are monthly paying dividends. So, on this channel, we love that regular cash flow, and we wanted to see what would happen if we invested money into these shares over a short period of time to a long period of time. Can we generate enough money to add to a retirement account and find out which one of the funds is doing the best? So instead of doing it independently, we're going to do them all at one time. So let's take a look at the purchase, how we are planning on doing this, what our strategy is going to be, and so on. So the first thing that the question is going to really bring out is this a good investment or a waste of time? We want to see is if we're putting $11,000 into this fund, are we going to get a nice return out of it and add it to a retirement account? Or is it just going to be just a waste of time because the funds don't produce? We bought all 11 funds on June 2nd. So we are starting this at the fresh part of the brand new month, June, and moving forward. We just took just $1,000 per fund, put it into all 11 funds for $11,000 total cash inlay into the program. Now, this is using no real strategies of just looking at stocks or finding the highs and finding the lows where we want to buy and accordingly. We're jumping in with both feet just to say, hey, we're into these. Tell me, how does it produce? They offer the monthly dividend payouts, as we've talked before. And what we're going to do here is we're just going to pull the cash out. We're not going to drip this. We're not going to do anything special. We're just going to pull the cash out, put it on the sideline, and see where we are each and every month. Our goal is to get a 9% average return from dividends and a growth of 5% in the fund. So basically in 12 months, we realistically should get 9% of our $11,000, plus we should get 5% added to it for about a 14% return. So this is how we start looking at funds saying, will this fit a retirement account? Do you want to put this into it and go from there? So let's take a look at now what each fund and what 11 funds are out there. What is each one about to get you a better understanding what NEOS actually offers us? The first one, most of you probably have already recognized, is SPYI. They invest into the S&P 500 for high income. The performance of this fund is not real exciting. 1 month they're down, 1 month they're up 3.81%. But 6 months down 6.4, year to date 3.43, 1 year they're down 1.13%. You will see as we go along, the April timeframe is what really hurts most of these funds, that they were dropped down to rock bottoms and they've slowly recovered themselves back up. Now, the nice thing here is they have a expense ratio of only 0.68%. The dividend is paying 12.11%, and the fund has been out there since 8 of 2022. Now, their holdings, we're going to see a lot of this, and that is in Microsoft, Meta, Broadcom, Apple, Google, Amazon, all the big high-tech stuff, which makes a better understanding why we're seeing this down in the 6 month and year-to-date categories because of the high-tech influence that's into this. So SPYI, we've talked about this. We've done different videos onto it. So it's a solid little piece to have in any portfolio. The next one, again, we've talked about this one, QQQI. This is the NASDAQ 100 high income fund. Their performance in the first month been good, 5.69. A little rocky in 6 months at negative 4.73. Year to date, they're down 3.67, but they're only down 0.12 for a 1 year calendar. You can look at the chart again. Everything goes right back to it. The March madness that we had, the tariffs of April 2nd, they kicked in and they've slowly recovered. This is why we thought this was a prime time to do this with these stocks, is that everything has kind of come out of a little bit of recovery and we're kind of back on the same road. But I think right now is a great time to buy into things, and we're going to see if I'm right or we're wrong. Expense ratio 0.68. Dividend return, 13.92%. It's been out there since almost 1 year now, January of 2024. Again, their big holdings are going to be in that Microsoft, Meta, Broadcom, Apple, Google, but they're also looking at a lot of NASDAQ 100s also. So then we go into the IWNI, which is their Russell 200 income fund. And again, we'll go through this one, 3.81 positive 1 month, down 17.31% for 6 months, down 9%, 9.87 for year to date, and it's up or down 11.58% for the year. This one has taken a huge hit. We know the Russell has taken a major hit. So again, this is one that we're looking at coming out of that April mess, recovering some, but not back to the performance that it once was. Expense ratio 0.68, dividend ratio 14.37. This one's a little bit newer, and that came out 6 of 24. They primarily hold into the Vanguard Russell ETF. Now remember, I'm telling you that these guys are selling option calls on all of these, and that's how they're generating their dividends. QQQH, this is the NASDAQ Hedged Equity Income ETF. Now this one shows some very positive numbers. In 1 month, 3.87, 6 months down 2.8, year to date, they're down 2.20, but 1 year, they're up 7.34%. We've looked at this one, we've evaluated this one a little bit closer. You can see they had a dramatic drop off for April, but they've recovered very nicely. So they're back up to about their $50 price range. So we think this is probably going to be one of those that you're going to want to have totally, or will be a performer in our fund. 0.68% expense ratio. Dividends down a little bit, 8.66%. Now this one's been one of their older ones. It came out in December of 2019. So it's got some years behind it. So it's got some time saying, yes, we know how to deal in bad markets, in good markets, and how to recover. They sit back and they do the Microsoft, Meta, Broadcom, Google, Tesla, Amazon, Apple across the board. SPYH, we've talked about this one. This is the hedged equity income for the S&P 500. Now, we were impressed with this one at the start until we realized this unit is a very new fund, but it's still up 3.64 for 1 month, 6 months, they're up 5.81. Now, I'm not going to say anything about the year to date or 1 year because the fund started in 4/2 of 2025. The day that all the tariffs kicked in, these guys went to marketplace. And I chuckled and laughed because that was the worst day that you could have entered into anything into a market. But they've been able to get into it. They recovered fairly quickly. They got back on track, and they've been doing well so far. So they're paying a 6.49% dividend, and their expense ratio, again, is 0.68%. Their holding is all the same, is that they're doing the Meta, Broadcom, Google, Amazon, just another way of them holding and selling. So their next fund is going to be BTCI, which is the Bitcoin High Income Generating Fund. Now, these guys have been doing very well at 7.66% over 1 month. 6 months down 4.72, year to date 3.49, 1 year 19.67% growth. As you know, Bitcoin going up, down every which way, that has just been a very option type item, and that's what this is doing as well. Now, I do not like that their expense ratio is 0.98%. I do like their dividend is 27.82%, and it's been out there since October of 2024. Now, primarily what they do is they do the VanEck Bitcoin, and they also do United States Treasury bills. So the Treasury bills, of course, if you don't understand that one, is that's going to generate some regular steady cash flow for them. So they'll get every month, they're getting some kind of payment into as interest, and hopefully using Bitcoin options to sell up and down every which way to generate the income. The next one's going to be IYRI. That's the Real Estate Income Fund. Now this one here, fairly flat, but it is, again, we're going to say this is a fairly brand new fund that they brought out. It's a 0.34% for 1 month, 0.83% loss in 6 months. And that's primarily, again, going for the April drop-off. The expense ratio, 0.68%. Because they're into the real estate market, this is like investing into a lot of REITs. They will have the 11.86% dividend return. And the fund came into as January of 2025. So realistically, we are 5 months old on this fund. Now their holdings, the holdings were kind of interesting because we started looking at this, and they do have a wide mix of different applications, from warehousing to retail space to office complexes. But they got some real solid companies out there. Realty Income Corp, most of you probably have heard of that one. Letter O. They do a nice job of what they have done. The Welltower has done a very, very good job of owning office buildings and keeping it full. So kind of interesting where this one's going to run as well. HYBI is enhanced income credit. This one here, bouncing again, 0.75 growth in 1 month, down 4.38 in 6 months, 2.96 down in year to date, and down 5.29% over 1 year. This one did take a nice drop in that April timeframe. It bounced dramatically back, but then rebounded back down and kind of leveled off where it's been at. The expense ratio is 0.68, dividend is 7.81%, and this one's been out since September of 2024. This one does basically bond market is what you're looking at. So when we look at bonds, we're not going to expect huge increases in bonds, but I really also have to ask and say, I don't expect to have big reductions and drop-offs in bonds. So unless they're buying a lot of lower level bonds trying to get a higher dividend rate, I'm not real excited and impressed with this one particular fund. Now, BNDI is the hedge equity income using the S&P 500. Again, down 0.81%, 6 months down 2.33, year to date down 0.11, and 1 year down 0.11. Their expense ratio is a little bit less, but 0.58. Their dividend issue is only 5.62. This one's been out since 2022. So this one is not, again, we're going to get deeper into this as we continue to watch these through the next few months. But it just seems like this one, it dropped in April, as they all did, but the recovery has not been coming back as strong as we would like them to see. This is one that I would expect them to be cranking back out and be positive numbers by at this time, even though they're only a few dollars short from being that. It's just one of those things that we're not real excited about. Again, it's a bond fund. We're not expecting this to be a fund that's going to jump high, low, or which way, but it should be a smooth sailing. When I look at bonds, that's what I expect. I want smooth sailing. I don't want roller coaster. So when I look at the board and say, okay, we do have fairly smooth, but we're losing. I'm not getting the dividend return. Maybe I want too much, but I would like to see a little bit higher dividend return and at least flat growth across the board. But again, we're going to watch this as we go through. Our next one is going to be CSHI, which is the enhanced income. This one's buying 1 to 3 month T-bills. This one was exciting to me, or interesting to me, I should say better, is how does this work that they're turning their fund over every 1 to 3 months with different bond funds. Very flat, very smooth. You can see it's a sawhorse across the board, up, down, and it makes complete sense of why they are doing what they're doing, because they're resetting themselves. So 1 month they're down, or they're up they're up 0.26. 6 months they're down 0.30. Year to date down 0.24. 1 year 0.16. I think that's pretty solid for this if you get the returns that we're looking for in dividends. Now, the nice thing is their expense ratio is only 0.38. Very good there. Dividend 5.04. Again, I'm going to ask for maybe a little bit more, maybe a little more challenge. It's been out since 2022. Maybe I'm asking for too much, but I would like to see, when we take a look in 1 year out, we lose 0.16. We're now down to 4.7, 4.8 percentage points from the dividends to call it even. Would it be just as good to take my money and put that money into a money market account that's paying 4.5 to 4.7 now and not even have to worry about any of this? That's the way I look at things. Again, this one uses all U.S. Treasury bills, and pretty much I could list them out about every 90 days. They're recycling. So they're coming due. They turn them in. They buy new ones, different interest rates, and so on. We'll see how this goes. Again, we'll have it in the portfolio. We'll see. If it changes much, we'll be excited. If it doesn't, we know where we want to be at. The TLTI is their enhanced 20-year Treasury bond. So this is one that they're buying and sticking out for a long period of time. Again, performance is not strong. 1 month out, now down 3.76. 6 months down 8.05. They're down to 8.05 in 1 year. Their expense ratio 0.58. Dividend 5.93. In bonds, again, I know they're doing Treasury bonds, but I think you got to look, if you want to be in the bond fund, maybe we need to look at other funds to do this. It's been out since 12 of 2024. And this one here, this is what we're looking at. You're buying U.S. Treasury notes and bonds at 4.125%, and they have them locked into 2053. So as we said, they're 20 years old bonds, and you're locking in at 4.125%. The dividends coming from other interest areas that they do, other areas, maybe some old bonds that they have coming through at. But this one you would have to buy ridiculously low price. We'll probably lose some money on this one in our program, but that's the challenge that we're putting out there. We'll take the challenge versus you guys. So the ETF lineup goes this way. We just went through in each and every one of them. We have basically taken $1,000, put it into each fund. We are going to buy it at opening bid on January 2nd, so we know the price tag that we're already paying for it, and we pretty much are going to get between 16 to 21 shares of each and every stock. Now, in dividends, we do the math across the board. We're averaging 10.92% in dividends if their numbers hold up. So we're basically looking at, we're going to be about 1.9% above our targeted goal. Again, as long as their dividends continue to hold and pay out accordingly. This is not going to be one of these that guarantee a 12% return. You're not going to guarantee a certain dollar amount every month. But what we're really looking at is, can we get $1,200 out of an $1,100 investment of 10.92%? So that gives you our lineup. Now I'm going to throw something even special out there for you guys. We're going to do Doug's picks and then lineup. So I sat down and said what I would buy right now. If I was to sit here and be a marketer and say, I got $10,000 to invest and I want to play the game, what would I buy? What would I buy into? And truthfully, I did not do this just to pick out high dividend returns. I wanted to get something that's going to give me a good dividend return and with some potential of getting me some growth. So I picked out five shares. I put $2,000 per share in each and every one of them. We will adjust this as we go along, but I have a potential of getting 16% dividend return with somewhat of a return across the board. If I get a zero return on stock value, I'll be ecstatic. If I get some return, we'll be even happier. As long as we don't lose our NAV, I could pick 16%. I would highly put this into my retirement account. So we're going to have two challenges going. One, buying them on a regular basis, and two is going to be Doug's picks, picking out the 5 best stocks out of there that I believe will work and go accordingly. So we're going to come back and give you guys a summary. Here's the May 30th, where we at. We got $11,000 tied into stock values that we're going to put out there. We don't have any income at this point in time, but we're going to do this review each and every, for the summary, we'll do it on a fairly regular basis, but definitely once a month, you'll get a review of exactly what this does. So hopefully you guys want to stick around, hit that subscribe button. Don't miss any of these. We're going to keep telling you what's going on and how we're doing in our fund chase. Guys, this is Doug, the Retirement Guy. I know we took a little bit more time than usual today. So hit that like button if you like this. Don't miss out on any of our great programs that we're doing. Hit that subscribe. And best of all, if you have any comments, don't be afraid to put them down below. Everything helps the channel grow, and we'll catch you next time.